Have you ever wanted to invest but felt overwhelmed by all the options? What if I told you there are just 3 ETFs I'd pick if I were starting today from scratch, knowing everything I know now? Forget the confusion. In this video, I'll show you the ideal ETFs for beginners looking for growth, stability, and passive income without needing to become a stock market expert. Like the sound of that? Then go ahead and hit the like button. Share this with someone who needs to start investing. And subscribe so you don't miss any content that can transform your financial life. Core investing principles. Before I show you the 3 ETFs I'd pick, there's one thing you need to understand. Good investing isn't about luck. It's about strategy. Making smart financial decisions requires clear principles and the ability to separate hype from what actually works in the long run. The trap of picking individual stocks. A lot of people think investing is all about picking the next stock to explode. Amazon, Tesla, Nvidia. But here's the hard truth. Most beginners lose money trying to do that. Why? Because investing in individual stocks takes time, knowledge, and emotional discipline. You need to understand fundamental analysis, read quarterly reports, analyze balance sheets, stay on top of macroeconomic trends. It's almost like having a second job. And even then, the best fund managers in the world still make mistakes. So why take that risk as a beginner? The advantage of ETFs. That's where ETFs come in. Funds made up of many stocks, traded on the market just like a single stock. When you buy an ETF, you're buying a slice of many companies all at once. It's a smart way to invest without relying on luck. Think of it this way. Buying one stock is like betting everything on one horse. Buying an ETF is like betting on the entire stable. If 1 or 2 horses lose, the others can still carry you to victory. That's diversification in action. Benefits of ETFs. Built-in diversification. Spread your risk without needing to buy 50 different stocks. A single ETF can give you exposure to hundreds of companies across multiple sectors. Low costs. Most have tiny management fees. That means more of your money stays invested and working for you. Passive management. They track indexes, no constant decision-making by fund managers. And research shows that, over time, passive funds often outperform active ones. Global access. You can invest in the world's biggest companies with a single click. No red tape, no hassle. Long-term mindset. The key is to think long-term. Stop checking the charts every day. The winners in investing are the patient ones. Warren Buffett didn't become a billionaire in a week. He planted seeds, nurtured them, and harvested over decades. The secret isn't timing the market. It's spending time in the market. The earlier you start, the more compound interest works in your favor. It's not about how much you invest, but how long and how consistently you invest. ETF 1 S&P 500. The foundation of any portfolio. If you could only pick one ETF in your life, I'd say go with the S&P 500. It's the safest and most strategic starting point for anyone looking to build wealth steadily and reliably. What's the S&P 500? It's an index made up of the 500 largest companies in the U.S., including giants like Apple, Microsoft, Amazon, and Coca-Cola. These companies are global leaders and power entire sectors of the world economy. When you invest in this index, you're not betting on a single company. You're betting on the strength of the entire U.S. market. And historically, that market has proven to be one of the strongest and most innovative. Examples of S&P 500 ETFs. SPY, SPDR S&P 500 ETF. One of the oldest and most popular ETFs in the world. Highly liquid and traded on major exchanges like the NYSE. VOO, Vanguard S&P 500 ETF. Has one of the lowest fees out there, just 0.03% per year. That means nearly all of your returns stay with you. Why is this ETF so powerful? High diversification. You're investing in 500 companies across tech, healthcare, finance, consumer goods. If one sector underperforms, the others help balance it out. Stability and strong track record. Over the past 90 years, the S&P 500 has returned an average of 10% per year. Sure, it has ups and downs, but always recovers and grows over time. Low cost. Investing in VOO costs less than a cup of coffee per year, for every $1,000 you invest. That makes a huge difference in your returns over the long run. Represents the U.S. economy. By investing in it, you're betting on the long-term strength of one of the world's most resilient economies. Even through crises, wars, and pandemics, the market has always bounced back. Why it's perfect for beginners. It's reliable long-term. You can sleep well knowing you're invested in solid, established companies. It doesn't require daily monitoring. It's a set-it-and-forget-it investment. It serves as the backbone of your portfolio. You can add other investments later, but the S&P 500 should be your foundation. ETF 2, Dividends. Passive income on autopilot. Want to invest and receive regular income without selling anything? Welcome to the world of dividend ETFs. Here, the focus isn't just growth. It's consistent, predictable cash flow. What are dividends? They're portions of a company's profit paid out to shareholders. Now imagine owning dozens of companies that pay you a portion of their profits every quarter. It's like your money is working for you and sending you paychecks. This kind of ETF is perfect for anyone aiming for financial independence. It builds a steady income stream that you can reinvest or use to supplement your monthly budget. Examples: SCHD, Schwab U.S. Dividend Equity ETF. Focuses on strong, reliable U.S. companies with consistent history of paying dividends. VYMI, Vanguard International High Dividend Yield, brings in international companies that also offer attractive dividends. This adds global exposure and geographic diversification. Why invest in these? Regular passive income. These ETFs pay quarterly dividends. For many investors, that brings financial relief and a sense of freedom. Stability. The companies included are solid. Think Coca-Cola, Procter & Gamble, Johnson & Johnson. They have predictable business models and strong profit margins. Pros. Great for supplementing retirement. You can treat dividends like an extra pension that adjusts with inflation over time. Provides predictable cash flow. You're not dependent on selling assets. You get consistent income. Can be reinvested automatically. Speeding up growth. Reinvesting dividends compounds your wealth and creates even more dividends in the future. Cons. Slower growth. These companies are mature and don't grow as fast as tech stocks. The main return comes from dividends, not price appreciation. Dividend taxes. Depending on your country, you might owe taxes on that income. It's something to consider in your strategy. Still, they're a great tool for anyone looking to build a balanced, resilient portfolio, especially if your focus is income. ETF 3, Growth. With a big upside lives. Want to invest in the companies shaping the future? Then growth ETFs are for you. They're perfect for those seeking capital appreciation and who are willing to deal with more volatility. Examples: QQQ Invesco QQQ Trust tracks the top 100 companies on the NASDAQ, including Google, Tesla, Meta, and NVIDIA. One of the most popular ETFs for innovation-focused investors. VUG Vanguard Growth ETF targets high-growth companies with strong upside potential while maintaining a good balance between risk and reward. What makes these ETFs special? Focus on innovation, tech, AI, biotech, clean energy. These companies are shaping the next 10, 20, even 30 years of the global economy. Profit reinvestment. Instead of paying dividends, these companies reinvest profits to grow faster. That drives long-term stock value higher. Higher volatility. Yes, prices swing more, but the long-term gains can be impressive. It takes stomach and vision to ride out the rough patches. Why they're worth it. You're investing in the future. Companies creating the trends the world will follow. Returns can be above average, especially if you stay invested for years. ETFs like QQQ have returned over 12% per year on average over the last decade. That means you could double your money in under 7 years with consistent reinvestment. Great for more aggressive investors with long-term goals. It's the turbo part of your portfolio. One tip: don't put all your money into these. They're great for boosting returns, but should only be part of your portfolio. Think 20% to 30% if you're just starting. Mix them with more stable ETFs like the S&P 500 and dividend ones. Now you know the only 3 ETFs I'd choose if I were starting from scratch. S&P 500, SPY, or VO are the foundation of any strong portfolio. Dividends, SCHD and VYMI passive income and stability. Growth, QQQ and VUG high growth potential. Remember, investing isn't about chasing fads. It's about building a smarter future. If you want safety, solid returns, and financial freedom, these ETFs are the perfect place to start. Like the video? Then hit the like button, drop a comment, and share it with someone who's just starting out. And of course, subscribe to the channel, because here you learn how to make your money work for you. And don't forget, your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth building strategies. See you in the next video.